financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
All right, friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you along for the ride today. As you heard, my name is Jerry Robinson. And today we're going to be talking about something very important, I think, specifically 3 strategies for a bear market. This is episode number 413. And this is a topic that I think is really, really pertinent right now. You know, many investors and traders know how to profit from an uptrend. They know how to buy a stock and see it go up. But relatively few investors and traders know how to effectively protect themselves from market downdrafts. And on today's episode, which I've told you is entitled 3 Strategies for a Bear Market, what we're going to be doing is we're going to be sharing 3 time-tested strategies that you can use to profit from the financial markets amid times of fear and uncertainty. Now, back at the beginning of this year, I began sharing several bear market strategies with our premium members here at followthemoney.com. And first, we conducted an exclusive video call with our members where we shared 4 powerful ways to profit from what appeared to be a potential downturn in the financial markets as we were heading into the beginning of the year. Then we also sent out several emails during the same time to our members, sharing with them specific ways to profit from a broader market sell-off. And I'm going to be sharing 3 of those strategies with you today on this podcast. And here we are now 4 months later, I guess about 4 or 5 months later, and the market has definitely taken a nosedive. This year, the S&P 500 index, for example, is down nearly 17% as of this recording. The NASDAQ 100 is down around 27%. That's a really, really big down year-to-date number for something as large as the NASDAQ 100 index, right? You also have the Dow Jones, which is down more than 12%. But that really only tells part of the story because several leading U.S. stocks have fallen even more sharply in 2022. Take Amazon, for example, one of the largest companies in the whole world, down 36% this year. Tesla, a major player in the U.S. stock market, certainly has become that way over the last few years, down 38% this year. The same thing with Salesforce. Then you have NVIDIA, which is down around 44% this year, just in 2022. How about Facebook, down 46%, PayPal, down 58%, Netflix, down 70% in 2022. I mean, this is very, very treacherous for the average investor and trader. 2022 is definitely an interesting year. And we hinted at this, a lot of this, in some of our previous podcast episodes. For example, back in episode 402 of this podcast, we talked about how volatility was back. That was back in December. We were talking about volatility and how it was raising its head in December. Then we did a podcast episode just a few weeks ago. Actually, it's probably been a couple of months ago, called Market Mayhem in 2022, where we kind of gave you some guidance on what we were seeing. And then just our last podcast episode, episode 412, was entitled "The Bubble is Bursting." So we really kind of dove into that big sell-off we've seen this year in the last episode. Well, what's driving the sell-off? Maybe we'll start there before we get into our strategies. What's driving this sell-off is a whole host of factors. First of all, you have inflationary fears, right? The Federal Reserve for a long time was trying to stoke inflation because they were in some ways fearful that inflation may be a thing of the past, like it seemed to be in Japan, right, where we had this deflationary problem. And the Fed said, well, we're just going to let inflation run hot before we intervene. Well, they certainly did let it run hot, much hotter perhaps than they ever should have, and they are now paying the price. So inflationary pressures, everybody knows that inflation is up no matter where you go, shopping, retail, wholesale, it doesn't matter where you are, what industry, prices are up. Then you have a war, which is exacerbating those inflationary pressures due to supply chain constraints and all of this, the war in Eastern Europe. You also have just a tremendous breakdown in retail earnings, very poor retail earnings. For example, Walmart last week reporting its worst, reporting a bad earnings report, but then having its worst day in like 35 years, falling 20-25% in a day. I mean, you think about Walmart, and it is, the largest company on the face of the earth by revenues, not necessarily by market cap, but by the amount of money. If you look at the register at Walmart and see how much money flows into that company, more money goes into the register at Walmart than any other company on the face of the planet. No company takes in more revenues. I mean, you'd have to go to the Pentagon at that point. That's the next institution that we see. The Pentagon takes in around $800 billion in fresh income per year, right? Because of the budget. Walmart takes in around $500 billion, right? And then it just goes down from there. So Walmart is by far has the largest revenues in the world of any company. Now, when you consider a company like that having its worst day in 35 years, that tells you something. Then Target reported, and they saw something similar, a tremendous decline in their earnings as well, 52% decline in Q1 profits. For Target. That's outrageous. And so we saw a really big sell-off in Target. Also Costco, which is another major retailer, one of the largest in the world, and it also suffering some major sell-off. So you have this retail issue that's going on right now, big retail wreck. Then you have, in response to the inflationary pressures, the Fed raising interest rates. And so the rising interest rates are also putting pressure on the stock market. And then on top of all of that, you have the slowing economic growth around the world. The IMF has talked about how the amount of growth around the world is just slowing as we head into 2020, the rest of 2022 into 2023. And so we suffered through this big liquidity bubble after COVID when the Federal Reserve pumped in a tremendous amount of money and fiscal policy makers, underneath both President Trump and now underneath President Biden, were pushing money into the system through the fiscal policy making process. And now you just have all this money that is now being sucked back out. So this liquidity bubble is being burst, and all of these prices, which were distorted by this influx of money, are now kind of coming back to earth, right? So we have, quite frankly, a very, very sizable problem on our hands. The Federal Reserve and policymakers here in the United States grappling with what has happened and trying to stay one step ahead of it. Unfortunately, it doesn't appear that's how it's working out. So with all of that as a background, I want to move in now to our 3 time-tested strategies for profiting from a bear market, and really just in general, financial markets, anytime that there is fear and uncertainty. So let's dive into those 3 bear market strategies right now. 3 bear market strategies. How can we profit in a time of great fear and uncertainty? Well, let's begin with the first strategy, and that is to go long on inverse ETFs. All right? Go long on inverse ETFs. This is one of my favorite strategies for dealing with a bear market. So let's first begin by defining the term. An ETF is short for exchange traded fund, and ETFs are much like mutual funds, except they trade like stocks throughout the day. ETFs have become extremely popular in recent years as they provide greater diversification by limiting your exposure to a single stock, typically. So over the years, Wall Street has developed a certain type of ETF, and it's called an inverse ETF. And an inverse ETF allows you to make money on a given sector, industry, or stock market index when it goes down. So for example, if you believe that the S&P 500 index, which is arguably America's most widely watched stock market index, if you believe that it's going to fall in price, then you could technically profit from your idea by purchasing shares of an inverse S&P 500 ETF. And as the S&P 500 index goes down, then your trade would make money as that happened. So there are inverse ETFs for many different types of investments, including bonds, commodities, real estate, etc. Just a few of the most popular inverse ETFs, which specifically target major indices, would include the Invesco Short NASDAQ 100 ETF. I use this one often. It's PSQ is the ticker symbol. You could also buy an inverse ETF on the S&P 500. The most popular one there would be the ticker symbol SH. But you can find inverse ETFs for many markets: the NASDAQ 100, the Dow 30, the S&P 500, the Russell 2000, emerging markets. You can short gold, you can short, any of these different, there's lots of different inverse ETFs. Now, I personally use inverse ETFs for hedging my long-term investment portfolio and also for taking advantage of downtrends. Now, you should know before you run out and begin trading inverse ETFs that many inverse ETFs trade on extremely low volume and therefore they should be avoided. Also, some inverse ETFs offer 2x or 3x leverage. And while these are very powerful trading vehicles, they can move very sharply in either direction. So you must exercise extreme caution when you're using them. And if you're new to inverse ETFs or if you've never heard of them before and you never use them to profit from a market decline, I would strongly suggest that you avoid any kind of leverage and first learn how these unique ETFs work by themselves before you begin to add on 2x or 3x. Because again, with an inverse ETF, like say SH, which is a short S&P 500 ETF, when the S&P goes down 1%, SH is designed to go up by 1%. But you can buy a leveraged inverse ETF that would actually go up 2%, like if it's a 2x inverse, or if it's a 3x inverse, then it would go up 3% for every 1% decline in the S&P. Now, you can imagine that could go really well for you, or it could go really poorly for you, all depending on how the market, moves. So you should know that inverse ETFs with or without leverage are strictly short-term trading vehicles. They should never be viewed or used as a buy and hold investment. And the SEC actually has a great educational article about inverse ETFs and leveraged ETFs that I strongly recommend that you read. In fact, I'll put a link to it in today's show notes so you can read that article. Or you can even just Google SEC and then inverse ETFs, and you'll find the article. It's a very important educational article that will help you. But inverse ETFs, we've been teaching our members how to use those for a long time. I personally use them to hedge my own long-term portfolio and also to take advantage of downtrending markets occasionally. So that's certainly one strategy for a bear market, is to use inverse ETFs. Very, very powerful way to profit from a downtrend. Let's move on to the second bear market strategy, and that is to use options, but specifically to use put options and to take advantage of them for your own portfolio or for your own purposes. And there's really two ways to approach this. People often think of making money in a downturn by shorting stock, and that is different from using put options, as I'm going to talk about here in a minute. Short selling stocks is where the trader is able to earn a profit if the stock falls in price. So when you short a stock, you are betting against that stock. And you're betting that the stock's price will go down over a certain period of time. And the process of shorting a stock requires that the trader first sell borrowed shares of a stock at a higher price before then buying them back at a lower price. While this can be extremely lucrative, it also carries enormous risks. So when you buy or go long a stock, your losses are limited to the amount that you place in the stock. If you put $100 into a stock, or maybe $1,000 into a stock, and then it goes away, well, how much did you lose? Well, you lost $1,000, right? But your gains are unlimited, however. If the stock, goes up, 1,000% or 2,000, it can go up as much as it wants. And so you really have unlimited gain potential, but your losses are limited to 100%. You can lose everything, but that's all you can lose. Well, when you short a stock, it's different. Your gains are limited, but your losses are unlimited. So to me, that's a poor trade-off, in my opinion. So put simply, shorting stocks is my least favorite strategy for dealing with a bear market. While I have successfully shorted stocks early in my trading career, I no longer use that strategy because I believe it's far too risky for my own tolerance level. And that's why I recommend avoiding that strategy. However, there are times when short exposure to a particular stock may be warranted. And maybe that inverse ETF is not going to give you exposure to this one stock that you believe is going to go down. And in that case, in that special situation, what I would consider doing is buying a put option on that stock that I expected to go down in price. So unlike the short seller who sells short a stock, the trader who buys a put option can still profit from the decline of the stock's price, but has limited loss and unlimited gain potential. So I prefer that risk-reward profile far above shorting stocks. We have created many different tutorials for trading and understanding options here at followthemoney.com. Our gold members have access to our options trading basic videos. Our platinum members have access to our massive 5-hour intense options trading educational videos, the Options Trading University. So using put options, buying put options on those stocks that you think have further to fall. You can also sell put options, and you can sell a put on a stock if you want to be able to buy that stock at a lower price and you receive an income while you're waiting. That's a really cool strategy, selling cash secured puts. But that's more of a advanced topic that we talk about in our Options Trading University. Now, that's strategy number 2, to buy puts. Again, we wouldn't sell short a stock. We don't like that risk-reward ratio or profile, but we do like the idea of buying puts, and even more so of selling cash-secured puts on those stocks that we would like to buy more of. And that brings us to strategy number 3 today, and that is to basically focus upon buying or adding more of your favorite high-quality companies. So, whenever you're in a bear market and there's fear and there's uncertainty and there's doubt, what we call FUD, many people are scared and they don't want to buy. They want to sell. They want to get rid of what they have. And far too often, new and even experienced investors are frightened out of excellent long-term investment positions due to fear. And unfortunately, fear will get you nowhere quick when it comes to investing. It's a poor attitude. It is a very poor emotion to be driving your decisions. In fact, fear will cause you to make poor decisions that you'll often regret later. So instead of getting fearful when the market turns south, this strategy number 3 is we say it's far better to look for opportunity amid the panic selling. Not trying to catch a falling knife. Obviously, we're not buying whenever the stock market is just going down. But we're looking for when the fear kind of reaches a maximum and the prices really begin to bottom. There is a really great opportunity at that time for you to get back in the market, or even better, just to add to your current positions in stocks that have been beat down. Like I mentioned, there are so many stocks that have been beat down so hard in this environment that you can't help but begin to see opportunity in the markets here. So ironically, many of the same investors who constantly complain that the stock market values are too high will not buy when the market values drop on panic or fear. And they begin to flee for the hills instead of taking advantage of the temporary price discount due to the downtrend. You pick any decade over the last century, and you will find stock market commentators complaining about an overvalued market, right? Historically, the stock market rarely seems cheap, and it's most often considered overvalued. A quick look at the historical price trend of high-quality stocks reveals that they tend to rise over time despite being perceived as overvalued by many investors. That said, no one says that you have to invest in stocks, right? You certainly don't have to. But if you're going to invest in stocks, it is crucial to take advantage of panic sell-offs and downtrends so that you may accumulate more shares of high-quality companies at lower prices over time. You see, unlike trading, investing is a long-term game, so you don't want to stop buying your favorite long-term stock investments that you were buying at highs. You don't want to stop buying them when they go down, right? That's the exact opposite. Instead, you want to add more of them when they're trading at a steep discount. Now, that doesn't mean that you want to just buy everything that's out there. Some companies may not survive, a sell-off. Some of them aren't high-quality companies, but I'm talking about the companies that have been around for a long time, that are high quality, even those companies that pay a strong dividend and they're increasing that dividend. When you move into a panic or a fear kind of scenario, adding more of those kinds of companies to your portfolio, if you have a long-term time horizon, is so powerful, so powerful. And like I said, don't think that this strategy applies to every stock. I'm referring to those stocks that are extremely high quality. I'm talking about companies that are committed to shareholder value creation through sales growth, earnings growth, proper share structure, a variety of other metrics as well that are important for long-term growth and value. And I even mentioned a few of my favorite companies on a podcast episode some time ago. It was called 3 Forever Stocks. I did that back in December. That's episode 403. And in that particular episode, I talked specifically about 3 companies that I own for the long term. That's Apple, Lowe's, and Visa. Those are a few of my favorite high-quality long-term stock investments. And so when these high-quality stocks go on sale, then it gets my attention. And so, as the markets are down, I'm still continuing to dollar cost average into what I perceive to be high-quality companies based upon my own investment thesis. And one of the things I did early on in my career that I really regret was, and I certainly have learned from it since that time, but in the beginning, I would not take advantage of bear markets. I would let the fear overwhelm me as well. And instead of continuing my dollar cost average, or instead of, taking advantage of those lower prices, I would just stop investing. And I think some people do this. It's just kind of a habit, or maybe it's just a reaction. Maybe it's probably a very natural reaction. So you may be dollar cost averaging when the sun is shining and the stock market's going up and you're buying. But then when the market crashes and people are scared and there's blood in the streets and fear is everywhere, then there's a human tendency to stop doing what you were doing. And even though you were happy to buy that high quality company at, $100, now that it's been cut in half, you're scared. You're like, well, may not come back, or the market, we don't know what's going to happen. Well, unfortunately, that can really mess with you and mess with your overall strategy long term. So remember, if you're a long term, you don't have to invest in stocks. You can go find something else. You can go real estate. You can go, you can forget the stock market. But if you're going to be in the stock market, then you have to remember that if you're going to do this for long term purposes, then you must take advantage of the fear. You must take advantage of the sell-offs, and you must not stop investing when the fear is at maximum. That's the time when if you're ever going to add to your stocks, that is the time to add. So I like the idea of just dollar cost averaging regularly and just not stopping that, no matter what is happening, and focusing upon our high quality companies that we invest in. And again, if something changes about that company, if you decide, well, this company is no longer meeting its, meeting its goals, or no longer meeting the aims, and it's no longer meeting the thesis that I had built for it, then sure, maybe you stop investing in that particular company. But as long as you have a conviction about that company, and nothing has fundamentally changed with that company, well, if it goes down 50%, then not adding it would be silly, because it will help your cost basis over a long-term time horizon, right? Again, not everybody wants to invest in stocks. Not everybody needs to invest in stocks. But if you're going to invest in stocks and you're going to do it for the long term, whatever you do, don't stop investing whenever the market goes down. That's where you're able to accumulate more shares of high-quality companies at a discount. So there you have the 3 different strategies for profiting in a bear market. The first one is to use inverse ETFs. Remember, use those carefully, do a lot of due diligence on them, understand how they work, and I would stay away from the leveraged versions of those until you had a really good understanding. And I would also probably paper trade those in the beginning to understand how they work, but I would not do anything until I fully understood them. And then, of course, you have the idea of using the options market, buying put options on stocks that you think will go down, or even selling put options, cash secured puts on stocks that you'd like to own if they come down a little bit more, and getting an income while you're waiting. Very cool strategy that we teach in our options trading university for all of our platinum members. And then finally, the third strategy would be to buy or add more of your favorite high-quality stocks whenever the fear is, here. Whenever the market is, when there's blood in the streets and there's fear, that is the time to be stepping in and adding to your positions in those high-quality companies. And if you don't know which company to buy, if you're not sure about stock selection, one of the very best things you can do is just follow the advice of Warren Buffett, who says, the best thing you can do if you just want to be in the market but you don't want to pick stocks, just buy the S&P 500 index, right? Index fund, an ETF. And that way you have market returns without having to play stock jockey and figure out which stock you're going to buy, right? Because that can take time. And if you're not committed to it, it could actually hurt you over the long term. You may choose the wrong stocks. But if you buy a simple index fund or mutual funds, or even just a solid index fund like the S&P 500, you're going to get those market-like returns, which will very likely help you beat inflation over the long term. So there are some strategies for you. I truly believe that these strategies will help you profit. Now, remember, we were talking about all of these things and even other strategies to our premium members back in January, getting them all set up and ready for what we're seeing now. What I really want to do is to encourage you not to lose heart, though, in a bear market. Over time, the financial markets will rise and they'll fall. And these cycles are not always fun. They're not even welcome necessarily, but they're an inevitable outcome of our debt-based economic system, which is vulnerable to booms and busts, which are largely created by America's central bank, the Federal Reserve. Instead of focusing on all of the negatives of a bear market, I encourage you to focus on the potential opportunities that surround us. Remember, amid every sell-off, there is an opportunity. The only question is, will you take advantage of them, or will you let them pass you by? Welcome back to Follow the Money, friends. My name is Jerry Robinson. Great to have you here. What we want to do now is we want to move into a brief crypto investing update. I want to provide you a quick update on what's been happening in the cryptocurrency markets. Since topping out near $3 trillion last November, the total market cap of all cryptocurrencies around the globe has fallen to just $1.2 trillion as we near the end of May 2022. Now, that represents an astonishing 58% collapse in the global crypto market over the last 6 months. Now, much of that decline has come in recent weeks amid the collapse of Terra and its failed algorithmic stablecoin UST, which rocked the crypto markets and sent shockwaves through the crypto investing community. Turning to the world's largest crypto asset, Bitcoin, it has been consolidating its steep 2022 losses just below the $30,000 level and a declining 200-day moving average. Although Bitcoin is currently locked in a long-term downtrend according to our trend trading system, we remain bullish on Bitcoin over the long term and actually maintain a $275,000 price target for the year 2025 on Bitcoin. Now, for short-term traders, however, they should pay particularly close attention to the $30,000 level right now. A failure to recapture that key resistance level in the coming days could signal more downside ahead. Meanwhile, the second largest cryptocurrency, Ethereum, is currently consolidating just below the $2,000 level and is trading down nearly 60% from its November 2021 peak of around $4,800. Exciting news emerged about Ethereum recently when we learned that its test network will undergo the merge next month ahead of the actual upgrade on the main network. For those who have been following the fascinating Ethereum project, many of you know that the project is actually in the process of moving from a proof of work algorithm to a proof of stake algorithm. That is a major switch, and that is known as the merge. Now, Ethereum developers have suggested just recently that Ethereum's test network for this new proof of stake system will actually undergo the merge in June, but then the actual merge, after all the testing is done, is expected to occur in August if everything goes according to plan. And if you've been following this story, you know that date may actually be delayed as well. Finally, while America is still struggling to provide clear and concise tax guidance for U.S. crypto investors, other countries have been less hesitant to lay out their own tax approach to the crypto asset class. For example, this month, Germany announced that it will not tax Bitcoin, Ethereum, and other crypto assets that are sold after 1 year of possession. Now, this is very positive news for German crypto investors. Let's just hope that the U.S. can get its act together long enough to create similar tax treatment for this emerging asset class. This brief update was brought to you by FollowTheMoney.com's Crypto Report, a members-only publication delivered each Friday afternoon by email. You can get instant access to all of our crypto investing educational resources, videos, and tools, as well as access to my own long-term crypto portfolio by joining us today. Learn more online at followthemoney.com/join.
Mr. President, there are 14 kids dead in an elementary school in Texas right now. What are we doing? Just days after a shooter walked into a grocery store to gun down African American patrons, we have another Sandy Hook on our hands. What are we doing? There have been more mass shootings than days in the year. Our kids are living in fear every single time they set foot in the classroom because they think they're going to be next. What are we doing? Why do you spend all this time running for the United States Senate? Why do you go through all the hassle of getting this job, of putting yourself in a position of authority, if your answer is that as this slaughter increases, as our kids run for their lives, we do nothing? What are we doing? Why are you here, if not to solve a problem as existential as this? This isn't inevitable. These kids weren't unlucky. This only happens in this country and nowhere else. Nowhere else do little kids go to school thinking that they might be shot that day. Nowhere else do parents have to talk to their kids, as I have had to do, about why they got locked into a bathroom and told to be quiet for 5 minutes just in case a bad man entered that building. Nowhere else does that happen except here in the United States of America, and it is a choice. It is our choice to let it continue. What are we doing? This community in Texas will never, ever be the same. Why? Why are we here? If not to try to make sure that fewer schools and fewer communities go through what Sandy Hook has gone through, what Uvalde is going through. Our heart is breaking for these families. Every ounce of love and thoughts and prayers we can send, we are sending. But I'm here on this floor to beg, to literally get down on my hands and knees and beg my colleagues. Find a path forward here. Work with us to find a way to pass laws that make this less likely. I understand my Republican colleagues will not agree to everything that I may support, but there is a common denominator that we can find. There is a place where we can achieve agreement that may not guarantee that America never ever again sees a mass shooting, that may not overnight cut in half the number of murders that happen in America. It will not solve the problem of American violence by itself, but by doing something, we at least stop sending this quiet message of endorsement to these killers whose brains are breaking, who see the highest levels of government doing nothing, shooting after shooting. What are we doing? Why are we here? What are we doing?
Well, we close out today's episode on an incredibly somber note as we pause to remember the precious victims of yet another senseless school shooting, this time in a small town in Texas. What are we doing? That was the burning question asked on the U.S. Senate floor this week by Senator Chris Murphy, whose voice you just heard. The pain, the suffering, the agony, the heartache, and the brokenness that afflicts the grieving families and their broken communities in the wake of yet another act of gun violence is overwhelming. There have been more mass shootings in America than there have been days in the year in 2022. And we stand with the victims of these heinous crimes. And we too lend our voice to the fight for common sense gun laws that prioritize the innocent above profits. Daily mass shootings are a uniquely American problem. And I have been speaking out against gun violence in America for years through our nonprofit organization, which you can find online at truerichesradio.com. While there are no easy solutions, I believe there are answers. And those answers may not come easy, and they may not please everyone. But for the sake of humanity, and for the sake of our children, we must stop the cycle of gun violence. A few years ago, I delivered a presentation on the topic of what the New Testament has to say about weapons and violence. And if you're interested, you can watch that video, which is available online at truerichesradio.com/Luke 22. Luke 22, that's the passage from the New Testament where I take the teaching from. May God have mercy upon this nation, and especially upon those who are grieving the loss of loved ones right now. And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
On the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.